good evening to all the participants and panelists. Trust you are doing well and are safe at home. So today's webinar is brought to you by Advice Sense Wealth. I am Sankalpo Pal and I take care of business development and client relations at Advice Sense Wealth. Today, we are a modern day wealth manager advising around 400 families invested around 400 CR in assets. And PMS AIF World is the platform from Advice Sense Wealth that engages in informed investments and superior portfolios that create wealth over longer periods of time. And today we are particularly happy to have the team of Axis PMS with us. So there is Manish Thakur from Axis and Trideep Bhattacharya, the fund manager of Axis Brand Equity. So I will give the floor to them. So Manish, I want you to begin with what is special about Axis and Axis as a fund manager, and what is special about the Axis Brand Equity portfolio. Over to you, Manish.
Yeah, thanks, Sankalpo, and good evening, everyone. First of all, I'd like to thank PMS AIF World for giving us this opportunity. They've created a fantastic platform, and I think what really differentiates them is the unbiased and informed decisions that they help clients to essentially make. A quick introduction to Axis Mutual Fund. Of course, Axis AMC is the asset manager who manages the scheme of Axis Mutual Fund. We are an 11-year-old organization. We started off in 2009, post the global financial crisis. A lot of learnings that we, as a team, when we came to set up operations, took from what happened during the GFC. And I think all of them have been beautifully implemented in the last 11 years. Today, as I speak, our total assets under management is close to around 1,30,000 crores, making us the 8th largest fund house in the industry. When we started off in 2009, we were the 44th player in the industry. So in the last 11 years, we've been the fastest growing AMC in the industry. In terms of our equity portfolio, today we manage close to around 54,000 crores in terms of assets under management. Out of this 1,30,000 crores, we reach out to as many as 66.1 million or 61 lakh happy customers who've invested with us. We are the 4th largest in terms of our equity assets in the industry. So the question is, what really has helped us in terms of growing our business in the last 11 years? I think one of the most important things post the global financial crisis, I think we said that there are 2 important parameters or factors which essentially drive wealth creation for an investor over a longer period of time. The return is something which everybody focuses on, but it's equally important that you essentially manage risk. So I think from 2009, what we've been able to essentially put to place is a very robust investment process, which is backed by an equally strong risk management system and process. And that essentially has helped us to deliver superior risk-adjusted returns to our investors over a period of time. And if you look at the performance of our funds across different time horizons, most of our funds on equities have been quartile 1, quartile 2, and that again has been demonstrated in terms of the institutionalization of the entire investment process that we've been able to build and deliver in the last 11 years. Just a simple example in terms of the way we manage risk, you all must are aware in terms of what's happened in the recent credit crisis. In fact, the last 18 to 24 months have been extremely challenging, for the mutual fund business on the fixed income side. And I think as an asset management company, very beautifully navigated. We've not had any major accidents, no major issues on our portfolio. And that really talks about the focus in terms of quality of companies that we essentially invest in our portfolio. As far as Axis AMC is concerned, we are a 75-25% joint venture. So 75% is owned by Axis Bank, that's our parent, and 25% is basically owned by Schroders, which is the oldest and largest asset manager in UK. As a part of our business strategy, 2016 is when we thought we'll probably extend our investment management capabilities, and we branched out into launching PMS and couple of AIF structures. And today we manage close to around 3,000 crores in terms of assets. The first product that we rolled out on the PMS side was the brand equity portfolio. So we're very clear when we launched in 2016, 17, that we don't want to launch another Me Too funds. There were too many large cap strategies, too many mid and small cap and multi cap strategies. We said that if we really want to add value to our clients and customers, we should be able to offer something which is significantly different than what others are doing. And what better product than the brand equity portfolio? As the product name suggests, this portfolio primarily focuses on brands which get consumed by most of us on a day-to-day basis. So while we all are large consumers of the brand per se, we've not really benefited in terms of the fortunes that those companies essentially have created or made, and the wealth creation that they've actually done for investors. So this is one portfolio which focuses on emerging brands and what you call as brand leaders in their respective segments. And we are very confident that by investing in these kind of companies and participating in their growth story, there's significant amount of wealth creation that we can essentially do for our clients and customers. The fund has got a 3-year track record, and if you look at the last 3 years, with the markets have been up and down, the fund, the portfolio has done extremely well. And of course, I'll tell Tridip to share a lot more details in terms of the fund performance. But before I hand it over to Tridip, I'll just probably do a very brief introduction of Tridip to the group out here. Tridip has actually been instrumental in terms of leading and building our entire PMS strategy. I'm happy to say that in the brand equity PMS, we today have close to around 3,500 investors, and we are managing close to around 1,000 crores in terms of assets under management. And we've been able to build a very strong 3.5-year credible track record on the portfolio. Tridip has joined us from Straight Street and from UBS. He brings with us with more than 20 years of experience in terms of being an analyst as well as in terms of managing money. In fact, the Brands Equity Fund or portfolio, I may say, was an idea which actually originated from one of the strategies that he was running very successfully globally. And we said, why not look at doing a similar strategy in India? Nobody's doing it, so might as well roll it out. And since then, he's been running it very, very successfully. He's a CFA. And more importantly, he's done his engineering from IIT Kharagpur, and also he's an alumni of SP Jain. We are lucky to have Tridip and his experience on board with us, and Tridip, along with his team, is solely responsible in terms of managing and delivering performance on the brand equity portfolio. So with that introduction, I'll hand it over to Tridip. Tridip, over to you, and if you could take the group on the audience in terms of your views on the market, and more importantly, speak on the brand equity portfolio.
Thanks, Manish, and thanks to PMS AIF World for inviting us to speak to their clients. And at the very outset, let me wish and hope that all of our listeners or viewers are actually healthy and safe in their at their homes. And while we talk about investing, life comes first, and hopefully all of us are in good shape as far as that is concerned. Of all the background that Manish actually gallantly gave to myself, I think the most relevant that I think is probably that this is my third recession. In other words, as participant in equity markets, I was the first recession I faced was in 2000. The next one was in 2008. And this is the third one that we are going through. So as we sort of talk about our strategy and how we think about investing, I think that's probably the most relevant part of my experience, which I hope to delve upon, and particularly during the Q&A that we'll have at some point. So I think, really speaking, today, or not just today, but at any point in time, there are two important decisions in investing. One is where to invest, and second is when to invest. So before we get down to the specifics of brand equity portfolio, particularly in an environment like this, I would like to take the audience through these two kind of important imponderables from an investor standpoint. And I would start with where to invest, particularly in the age of unknowables that we are kind of going through at the moment. So what are the unknowables? Well, the biggest unknowable is at the moment the corona crisis, obviously, as a health scare. While we are all keeping a tab of the latest count how that is progressing and which have we flattened the curve or not. The fact remains that we have still not come through the end of it. And the other part is we don't know when it will. And so one of the biggest unknowables that we are going through at the moment. The second, and related to this, is the fact that the economic damage that this sort of a crisis that brings along with. Since we don't know the time frame of this unknowable, we also don't know the extent of economic damage that will be there. Third, and very significant is the oil price. For the first time in the history of markets overall, I would say that oil prices touched negative. That is really one of the unknowables as to where that will settle, not just for business managers who plan their businesses going forward, but also for us as equity managers. So, where do we invest in such, when we are faced with such big unknowables? Here are a few thoughts. Knowing what the unknowables are, it's very evident looking at the equity market's behavior in the short term that almost all the businesses have been treated in the same way, both quality and non-quality. Uh, Whether it's high quality or low quality, the prices are down anywhere between 20 to 35%, depending on which business that we are looking at. While that is the scenario in the short term, as we kind of navigate through this crisis, I think investors should particularly pay attention to this, that markets will start to distinguish between different types of business. What do I mean by that? Markets will start to differentiate between businesses which are leveraged versus which are non-leveraged. Businesses that are naturally cash flow rich versus businesses that are cash flow starved on an ongoing basis. And finally, the businesses that are in the sectors that are at the epicenter of the crisis. So, in my view, on the other side of the crisis, which may take 6 months, which may take 9 months, the market share winners or the winners overall will be the ones where the businesses are underlevered, cash flow rich, market leaders, or their brands in their individual segments, so to speak. And these are the crises that I have seen personally during my career. The second thing to be careful about is basically the sectors at the epicenter of the crisis. Let me elaborate on this a little bit more. In 2008, going back to 2000, it was the tech. The tech sector was at the epicenter of the crisis. And what we noted is that coming out of it, there were lesser number of businesses, and the valuations and the dynamics of the businesses for those particular set of companies actually changed materially. So the tech sector did go through structural change at the end of once we came out of 2000. Let's look at 2008. And in this case, financial sector was at the epicenter of the crisis. And we saw that global banks went through not only quite a few bankruptcies, but structurally speaking, the ROEs of the global banks were about at least 3 or 4 percentage points lower than what they were pre-crisis. So they also went through structural change. Now let's come to the current crisis that we have. The sectors, if you ask me, at the epicenter of the crisis are basically media, entertainment, travel, and leisure. These sectors, in my view, one has to be careful while investing because there could be some structural changes that will come out on that we can see, that we will see as we come out on the other side. How do we do that as an investor? Well, either we invest bottom up, or either we basically invest on a direct basis, in which case we have to look at business by business rather than going by macro variable like large cap or small cap or mid cap or sectoral strategy. We have to go with the fine tune of what business they are in. Are they leveraged? Are they under leveraged? Are they cash flow rich or are they cash flow starved? And are they in the sectors at the epicenter of the crisis? So the need of the hour is not just blanket investing across the board, but rather bottom-up strategies which look at stock-specific characteristics rather than taking sectoral bets. That's number one. Secondly, in my view, the segments of the market which will emerge far stronger than when they went in were brands or would be brands or the market share leaders in their particular segment. So investors are well advised to sort of orient their investments towards these two kind of broad categories that they are. While the near term is extremely uncertain, and it's very difficult to put a finger on FY21 earnings estimates. But it is not too difficult to figure out in each of the sectors or in most of the sectors, which are the leading brands, which are the brands which have gained market share, which are the brands which are underlevered, which are the brands which are cash flow rich. And that is, my friends, what we do at Axis Brand Equity Portfolio, which brings to the second section of this call as to what do we do at Brand Equity Portfolio and how have we navigated through this crisis. I would say at Axis, as Manish mentioned, this structure, this portfolio is close to my heart in the way I have done for better part of my career. And I would say that there are 3 or 4 guiding principles that we strictly follow at Axis Brand Equity Portfolio. Number one, and most importantly, we use brands as a tool for wealth creation. Now, while there are other strategies which also invest in brands, we do only brands. And what we focus on is on a bottom-up basis, how the brand has evolved from being an emerging brand, which is a brand in the earlier part of their life cycle, to becoming an established brand, which is a national brand, so to speak, and also looking at a few turnaround candidates overall from a perspective of investors, but all with the idea of wealth creation for investing in equity markets. While we've used brands as a theme in all our life, when I came back to India, as Manish mentioned, from London about 3 or 4 years ago, and I noted that across the street there were many strategies, but none which was focused on brands as a key theme. And hence we did the same over the last 3 years. We got good response from investors, and both in terms of performance as well. And we think that this is an evergreen theme. We think that from brands perspective, India today is where United States was in 1970s, 80s, or Korea or Japan were in 80s, 90s, where branded consumption, whether the end user is a consumer or a business, is just about starting up. And the jaws in the form of outperformance of brands in general versus broader markets is only going to accelerate on a secular basis over the next 10, 15 years. So this is an evergreen theme, not just a cyclical or not just a time-specific theme. And hence, we launched a strategy around that. That's the first and foremost differentiating characteristic and most important characteristic of the PMS that we run, that we use brands as a tool for wealth creation. By virtue of the fact that we do use brand, all the businesses that we have in our portfolio are under-levered and cash flow rich. So we naturally fit into the analysis that we kind of put out in front of you, that overall, if you look at this crisis, they would stand to be one of the big gainers on the other side. Um, the second important point that I would highlight in the context of our brand equity strategy is that we are not just using brand as a marketing tool. We have a solid process that we go with, which is a mix of quantitative and qualitative parameters through which we zero in with a list of brands, anywhere between 15 and 25 names, which could be a strong tool for wealth creation for investors over time. These quantitative and qualitative tools are primarily biased towards the efforts that the company has made in creating a brand, in the spends that they have done on an average over the last business cycle. And second, we also look at whether the growth and the return ratios are meaningfully higher than the GDP growth and the cost of capital. Because otherwise, there is no sense in evaluating a brand or no sense in investing in such a company. So that's our second point, that the process is important to the way we run the portfolio. We have been able to do that for the last 3 years successfully. And partly the reason why we have avoided a lot of disasters that have come about, some from corporate governance, some from otherwise, is because of our sound reliance on analysis and bottom-up careful stock picking. The third and the outcome of this process is a portfolio which is a mix of 3 buckets. On one side, we have what we call as emerging brands. These are brands in the early stage of their life cycle, maybe regional brands. They are focused on one particular segment, and they are looking to go national as they gain market share over a period of 5, 10 years. A classic example in this case would be a company like Viga, which is a company from down south and makes switches, cables, inverters, very strong, very high on corporate governance, and gradually looking to make inroads into the north and rest of the parts of the country. This segment, which is emerging brands, forms about 40% of our portfolio. These are high potential candidates which can give us a lot of alpha, but occasionally could have some mishaps as well. And hence we don't overwhelm us with the entire portfolio, but limit it to about 40 odd percent. But companies with high alpha potential, companies that have significant scope of expansion going forward. The second example, the second set of companies or the second bucket in our portfolio is what we call as established brands. These are well-known companies. They do not grow as fast as the emerging brands, which was the earlier category, but they are far more steadier in the way they grow. And hence, on a risk-adjusted basis, provide investors with a steady bedrock of returns over time. These are an example in this case would be Asian Paints, where despite the volatility that we have seen in the past, by and large, they've been able to manage the growth in a far more sustainable and a far more resilient basis, particularly with crude going all over the place. This forms about 45% of our portfolio and ultimately gives a steady bedrock of return, few sleepless nights, and provides steadiness to the overall portfolio. The third bucket is what we call as turnaround brands. Companies which have had a strong past, which have been strong brands in the past, but have fallen by the wayside for either some management specific faux pas, or for that matter, or for that matter, if you look at uh, um, uh, overall with regards to stuff coming back, they are gradually on the mend. So when we look at these sort of companies like ICICI Bank or Axis Bank, for that matter, there is meaningful amount of turnaround that is yet to happen in front of us, and we look to play that. So that's about 10 to 15% of our portfolio. And the idea behind this sort of part of the portfolio is ultimately to generate market agnostic returns rather than anything else. So we think that that could potentially kind of give my idiosyncratic alpha. So broadly, three parts to the portfolio: emerging brands about 40%, established brands 45%, and turnaround candidates or turnaround brands about 15% overall. The fourth characteristic that I would make of Axis brand equity portfolio is that we tend to do quite well in volatile stroke down markets. So if you look at our performance over the last 1 year, ending March 31st, which is the latest data sheet that we have, by and large, the broader markets have fallen anywhere between 25 to 30%. Whereas if you look at our portfolio has fallen about 14 odd percent, which means on an average, we have generated an alpha of 1100 basis points, so 11 percentage points over the last 1 year. And similarly for 2 years, 3 years, and since inception, the numbers are quite strong. But I would sort of particularly highlight the last 1 year because we have seen the mother of all crises in the form of healthcare that we have kind of, at the moment. And that is testimony to the fact that we tend to do better, particularly when markets are volatile or markets are down. And I would say that, that is why, while quite a few strategies have fallen by the wayside, particularly in tough markets, we have held our shape. This is important and distinguishing characteristics amongst the competition. And the reason I say so is, let's say you bought a stock around 100 rupees. And for whatever reason, the stock actually halves, goes to about 50 bucks. So you've lost about 50% of the value. But what is worth remembering, investors, is that for you to break even now, the stock now needs to rally 100%. In other words, money saved or money preserved on the falling parts of the market helps in wealth creation in a meaningful way over long periods of time. That is one of the strong underlying philosophy with which this portfolio is run overall. So that's hopefully kind of summarizes the first part or the main part of what I wanted to say as prepared comments as to where to invest. We think the time is to invest in brands, in leading leaders in the sector. And an example of such a candidate would be our Axis brand equity portfolio. And we went through some key characteristics of the same. In the form of when to invest, we think that the valuations, if you look at it currently, are about 10-15% below long-term average. So this is a good time to get started. Normally, kind of, brands or quality companies don't appear cheap. This is one of those circumstances where over the last couple of years, earnings growth has been 20% per annum in the portfolio, but the overall broader markets have corrected, taken the prices back to 2-year back levels. So one of the few times where quality stocks have corrected meaningfully, I think it's a good time to sort of, take advantage of that. Should we put money in lump sum? My sort of 2 bits on that would be not really. We should put money in tranches over the next 3-4 months because we have not seen the end of volatility so far. We think the markets are going to be volatile. There could be a little more downside. So as we said, that particularly in volatile markets, we tend to do better. So ours is one of the strategies which hopefully kind of cushions you on the fall, but prepares you well for the next 3-5 years. So that is what all that I had to say, and I would stop here and see if
Thank
my
you,
good friend has
Trideep.
a question.
Thank you, Trideep and Manish. That was really insightful. And Manish, thank you for the background of Access AMC per se. So the first question that we've got and is a very interesting one, and Trideep or Manish, anyone can answer. So
Sure.
brands, as we know, have a life cycle, like you said, in your portfolio too. They emerge, they mature, and perhaps the lucky one stay where they are, and few go into disappear. So we have seen, like you said, India is what was America in the 70s, or Korea and Japan in the 80s and 90s. The brand life cycle or the life stages have shortened. To say, if I have to think of an example, Kodak, the camera guys lasted for decades as champions. BlackBerry could not hold it for more than a decade or half a decade. So life cycles or life stages have shortened. So what is your take on that? Considering you run a portfolio of brands, I would like to, the audience would like to get an answer on that.
Sure, I'll take that, Manish, if that's all right.
Yeah,
Um,
please.
so I would say that you're absolutely, I think whoever has asked the question is a fantastic question, which is why at the outset we said that we are a bottom-up strategy. We carefully look at how the brands are evolving. And one of the big things, I've written an article on this, that overall brands are slowdown resistant, but innovation hungry. In other words, as long if the brands don't move in tandem with that of the latest trend, or in terms of connecting with the customer, whatever whosoever their customer are, tend to fall out, and that can only be identified based on bottom-up analysis rather than otherwise. Which is why we at Axis, particularly on the PMS side, we are absolutely bottom-up investors. We may not know the latest COVID count, or we don't know whether the strategy or the economic stimulus will come tomorrow or day after or will not come. But we can tell you of all of our portfolio holdings, overall how the brand, the promoter or the key founder of the company is going to take it for the next 3-5 years. So what you point out is a key risk, and we are very mindful of that. But by and large, that's why we think that even though it's brands, it's not one structure fit all. Once we get into this stock, we do monitor on an ongoing basis, so that we don't we don't get too comfortable or complacent with regards to where the brand is. And there have been examples in our portfolio over the last 3 years where we have seen that things are looking to meander, and we have taken exit calls so that we are kind of rightly positioned, and we've sort of we can get and we've stayed away from the mishap, so to speak. So overall, that's one of the key areas of risk we monitor carefully, and on a bottom up basis, most of our analysis is focused on the same.
Thank you, Trideep, for that answer. So the next question that we will take is, how long do you think, like you mentioned in your strategy description, that your portfolio sales was growing somewhere at an average of 20%. So how long before you think that the previous run rate can be achieved in the post-COVID world? And I will add an addendum to that question. What kind of new brands can emerge out of the COVID situation? Over to you.
Yeah. So, as I said, that the unknowable that we are dealing with at the moment is the length of this COVID crisis. We don't know whether it's 3 months or 6 months. So I would not hazard a guess on whether it's going to come back in 6 months or 9 months. But I would hazard a guess certainly in the type of business that I would point my finger on in this time. I know that on the other side, Asian Paints would emerge as a stronger company, whereas a lot of their competitors will actually disappear. I know that in the jewelry market, Titan will continue to grow, maybe lower, maybe about 10%, in this year, and they will kind of grow. They'll take some time to come back. But in the sector where they will be mired with bankruptcies because of lack of funding, and because stores are closed and it's a high fixed cost business, Titan would gain tremendous amount of market share over a period of time. Similarly, I know that Whirlpool would actually kind of gain good bit of market share, particularly in tough times, because almost about 30-40% of their market cap is in the form of cash. Because essentially, the names that I mentioned tackle to what we call as deferred demand as opposed to lost demand. So, I gave you the example of Whirlpool. So let's say you have a refrigerator at home. Maybe we are all locked in and maybe all don't buy anything for the next 1 month or 2 months. We postpone our purchase. But if your refrigerator is off, you'd stay in tropical climate, you will have to go and change. And the first name that comes to your mind is Whirlpool in that context. So whenever that happens, the deferred demand will prompt your demand to really come back. That I'm reasonably sure. And hence, whenever it comes back, maybe in the say later half of FY21 or in FY22, we will have a strong comeback from for Whirlpool as an example, even though the near term might appear to be a little murky. Same goes true with Titan. The growth rate would continue to be sort of, while there have been quite a few Gitanjali gems and multiple names which have gone bankrupt, we know on the other side they will come as stronger. So at the moment, to answer your question, the time is not to be precisely correct on the earnings estimate on when it will come back. The time is to get oriented in the right types of companies. And as long as they can tide through this weak period, on the other side, we have wealth creation standing anyway. So that's what I'm kind of focused on at the moment. Hopefully that gives you an answer.
So the second part is of that question was, when do you what do you think will be the new brands that can emerge, or broader, what sectors can emerge?
Yeah. So in my opinion, I think the jury is still out on that one as we are navigating through this crisis. The longer we go through this, the scope of newer sectors or newer leaders would actually will go even higher. But I could see some incipient trends already. One is the fact that pharma sector, which has been kind of in the doldrums for a good while, you know, they've seen a good consolidation of valuations. They are now gradually seeing kind of some part of their portfolio coming back, both in the United States and India. Could be once a sector which will benefit from in the post-COVID era, because vaccination and the health awareness of consumers which generally go up. The second aspect I would hazard a guess is that work from home becomes a structural part of our life. And as that happens, telecom or companies which are in the telecom chain could stand to benefit from the same. Tech Mahindra being classic example of the same would actually see some benefit from a trend like that. So there could be a sector coming from that. Consumption as a story, particularly companies on the deferred demand, would be the ones which will come back very strongly. So I would think that consumer discretionary would stand to be a key beneficiary as we come out on the other side. Because once we start rebuilding stuff, we would need to sort of get back on our feet quickly than otherwise. So these are 2 or 3 areas where I would think things might evolve. In the case of financials, I think overall the from pure lending sort businesses, money in type businesses like AMCs, like Manesh was mentioning AMCs, insurance companies, those would see probably a better portfolio allocation than pure lenders, which might be bearing the brunt of socialization of losses. So, I mean, it's an evolving scenario, but those are a few areas which I could emerge as winners from this segment.
Okay. Thank you, Trideep. Now, Manish, I will quickly get you into the picture and I will ask you a quick question. Like in the onset, you mentioned you manage both mutual funds and PMSs, and PMS is typically a newer fund for you. What do you think is that distinctive advantage in a PMS opposed to other, investment vehicles, and how does it help investors create wealth over a long period of time? Please, Manish.
Sure. Thanks, Alkalpo. I think it's a very relevant question. And what we are seeing on the last 2-3 years in terms of trends, increasingly clients, and I'm talking of people typically who are high net worth individuals, are preferring PMS as a preferred route. Some of the benefits, if I have to really highlight on PMS, I think the first is the flexibility that a fund manager gets in terms of investing. Remember that regulations, and if I would say a product which is closer to PMS would be essentially mutual funds. The regulations are getting very, very tight around it. And to that extent, there are strategies and objectives which are built around a particular scheme. It doesn't allow or doesn't give fund managers that much flexibility in terms of, moving his portfolios. To that extent, PMS offers a lot more flexibility in terms of moving around market caps, as well as in terms of themes. Uh, Another example, great example, is in terms of cash calls. In a fund, it's very difficult to basically take a huge amount of cash call. You're not allowed to do that, and you don't see that happening in PMS because you're running individual portfolios. That flexibility is there. Increasingly, we are seeing customized investment solutions coming, new themes coming. Look at brand equity as a theme. These are kind of opportunities that are essentially getting created for clients and customers. A lot more transparency. Clients sometimes keep asking that, how will I know at what price I've essentially bought a stock on my portfolio? I think PMS gives that flexibility in terms of what level he's got the stock, what is the price that he bought the stock on the portfolio, what are the costs in terms of brokerages, etc., which typically you may not get into, other investment options. I think one of the big advantages that you essentially have on PMS is that you run a separate portfolio. And a classic case is what you've seen off late happened on the on the credit funds. You saw a big run up happening in credit funds. Now, as an investor, if you're invested in a fund and if you don't redeem your money and continue to remain invested in the fund, you bear the brunt because of some other large investor pulling out the money from the portfolio, and that impact comes on your portfolio also. Whereas these are segregated, they are separate portfolios. So if somebody redeems the money, okay, it doesn't have any impact on your portfolio. So I think that's the other big advantage that, and especially when markets tend to get a bit illiquid. And lastly, I would say is, of course, there's a lot more flexibility in terms of stock universe. There are a lot of companies sometimes because of mutual fund, fund sizes, you're restricted in terms of buying certain companies because you don't get too much of liquidity in that stock. Well, that could be possible typically in a separate or a segregated portfolios. So these are some of the things which actually are things which investors should look at, which are in favor in terms of holding or having some exposure to PMS on your portfolio.
Sure. Thank you, Manish. So Trideep, now this question is for you. So this is a very interesting question. The economy is in somewhat a very uncertain kind of a space. So you don't know where it goes from here, but the stock markets, not just in India, but across the world, appear pretty resilient and, don't show the same kind of uncertainty. So what is your take on this, the divergence between the economy and the stock markets?
So let me put a bit of data in front of you, which is that the form of correction that we saw in the month of March, which is close to about 30%. If you look at past crises, 2008 or 2000 or whatnot, what used to happen in 6 months or 9 months happened in a duration of 1 month. So that was the pace of correction. And generally, we as humans, behaviorally speaking, we have a time element to the way we think about crisis, that, okay, this lasted for this long. So, but along with the time element, which is this lasted how long, the extent to which it falls is also matters. So I would say that versus how much, how long it lasts, how much it has fallen also needs to be put in context. And in that context, you would see that the markets fall. The first round of fall has been quite in sync with the way we have seen in the previous crisis as well. Now, if you go and study previous crises, you will find that within that, there have been various counter trend rallies, which we call it bear market rallies and whatnot. And so we have seen a bit of that come through in the month of April, which is called a low conviction rally, or a bit of pullback from the lows that we speak. So I think as an investor, so those are the data in front of you. Now, as an investor, you can get whipsawed by one month the market's being down 30%. The next month the market is being up about 15% or you can focus on the underlying fundamentals of the companies as to what business models are these are you orienting your investment towards. Are these strong brands? Are these market leaders? Will they emerge on the other side? If they are, and if they are kind of at about 20% lower valuations than where they were, then broadly speaking, if you hold on to your nerve and allocate probably a little more capital, particularly in times like these, you're going to emerge as a winner. So I would not get too much into the emotional quotient of why the markets have rallied or fallen versus that of where the economy is. I would just look at the bunch of companies on a bottom-up basis that we are invested in. it is still possible in India to find a bunch of 20, 25 odd companies, which I can say in 3 years' time will grow earnings at the rate of 20, 25%. Now you can do all sorts of macro analysis, get yourself tuned with the latest various counts, but as long as you keep focused on those 20, 25 strong brands and they continue to gain market share, you are sorted with regards to investment goal is concerned. So I would say that rather than getting confused with macro, focus on bottom of fundamentals. Is this a company under levered? Is this a company cash flow rich? And by and large, is it kind of not in the epicenter of the crisis? By and large, that's what we do at Axis Brand Equity Portfolio, and I would recommend that approach for investors as well.
I think that's very profound coming from someone who's seen 3 crises, and I think experience speaks. So the next question I think is very interesting. How do you quantify brand advantage or brand value? And the question is, how do you know mathematically that this is a brand to look at and this is a brand that we can let go?
You're asking a magician for his tricks. So, but there is no trick really. It's very simple. I think, it's the same with our business. I can talk all day about brands, but ultimately if Manish can't drive the business, there is no point in me just talking about that. The way to quantify this is ultimately the success of a brand is basically the market share. Now, we've been one of the fastest growing PMSs over the last 3 years. And that talks about we can talk all about performance and whatnot, but net, that's the resultant of that. So putting in more formal terms, I would say that market share is a good way to gauge whether the brand is working or not. Secondly, return ratios is another way to gauge whether the brand is just being distributed for free or it is actually making economic return. And then one has to, those are the easy sort of gates or hoops to cross. After which one will have to get into the dynamics of, which sector they are in, what is the structure of the business that they are into, is that an oligopoly, and what is the chance of this company in 20 years' time emerging as a far stronger company, as opposed to a big fish in a small pond. And those take a bit of gray hairs and a bit of analysis to go through. We'll leave that outside the purview of the discussion. But broadly speaking, those would be the parameters that I would say that gives you some sense that the brand is working.
Thank you. That was quite interesting. So the next question that I will take is, is pertinent to autos as a business. You said that this is the time where you don't really look at the divergence between the sectors and the stock markets. You take positions in companies you believe, in brands you believe will do well. Autos is one such sector where the divergence is huge. I mean, Maruti said they did not sell any car in April. So that's how huge it is. So what is your take on autos as a business, and are we likely to see any autos in your portfolio in the near term?
So autos is a very interesting sector at the moment. If I look at the tailwinds that come out of Corona virus case, I would say that, with personal mobility might come back in vogue as opposed to shared mobility, particularly given that there are concerns around social distancing and whatnot. So that is going to be a beneficiary for the auto sector. But on the other side, you have BS6 norms, which basically means that the vehicles are about 5-10% more expensive than what have been in the past, which particularly in times of economic distress could mean a bit of onerous particularly for users. The third is electric vehicles are kind of round the corner, and the kind of the promises that they have towards a clean world also is a trend that is there. So bottom line is that autos as a sector are seeing quite a few trends, some positive, some negative. How do we navigate through all of this? So one of our leading positions in our portfolio is MRF. Now let's look at the first trend that I'm talking about. If we go towards more personal mobility, people buy more cars, they have to buy more tires, because ultimately the car won't run without the tire, number one. Whether it's a PV or an EV, the tires will continue to be still old-fashioned, irrespective of whether you buy an electrical vehicle or and third, I would say they don't have any price hikes or price issues to go through, and they have a huge replacement market, which makes brand an important component of decision making or buying for an end user. And finally, in the context of framework that I laid out earlier on your call, this is part of deferred demand. If you have a flat tire at your home today, you may not want to go and change your tires because you're locked out. But as and when over 3 months you go to office, you will have to kind of change the tires. So this is an example of deferred demand and not lost demand. For some OEMs, there could be lost demand, or battery companies, there could be lost demand because if they go to EV, things could be different. So I think, again, the bottom-up characteristics make sense. To me, MRF being a leader in that, is a key brand that I'm playing through this. I also have an exposure in Kansai and Nerolac, which has a high exposure to autos, which gives me a similar exposure, but without getting sandwiched by some of the structural headwinds that these companies might face. So different ways to kind of, skin the cat. This is my way of going about it.
Okay, thank you. Thank you. That's actually really helpful to understand the thought process at Axis. The next question I will take is, what do you think are the negatives that are not yet priced in? As in, what the market is not factoring in right now and could weigh in at a certain point in time in near future is the question.
I think it's a good, insightful question. I would say that at the moment where markets, what is still going to be what still could be a black swan even for the markets would be if we have a big second wave in the coronavirus case. In other words, we come out by June, July, relatively clear. We flatten the COVID curve, as the experts would put it. But what happens if in December, January, we see a second peak? I think that remains an outside Three Sigma event, which is probably kind of, not factored in at this point in time and will have to be carefully evaluated over time.
Okay, thank you. So the next question, I think both Manish and you can answer. It's a very interesting question. Does the brand equity portfolio only look at domestic brands or Indian companies that are brands globally? And I think I will, resonate with this question because IT is a very small part of your portfolio and pharma is also a very small part. And if I have to think of Indian brands being global brands, I would look at these two sectors. So please respond.
So I would say that given that ultimately, India is a huge market in itself. We are fourth or fifth largest in the global economy. So don't underestimate a domestic brand. Very soon, particularly given the situation in China, the global companies might be at our doorstep trying to participate in India's growth trajectory, rather than Indian companies having to go abroad and do so, which is all good, but this is an important market as we speak. So our portfolio at the moment is loaded towards domestic brands, primarily because India is a hugely underpenetrated market. Only about 30 to 35% of Indian market is still organized. About 65% of the market is still unorganized. And all this unorganized market is full of, private labels or small mom and pop stores or small mom and pop brands, so to speak. All of this over the next 10, 15 years will gradually get formalized. We'll actually see proper brands kind of, coming through, and this will be homegrown Indian brands because Indian audience have an increasing tendency towards moving towards homegrown brands. Having said that, we haven't not neglected global companies with global exposure. So we do have select pockets where we think Indian companies are doing well globally as well, particularly in tech and pharma. That's about, I would say, close to 20% of our portfolio, which is not that small, but doesn't overwhelm the portfolio.
Okay, thank you. That was a very quick and sweet answer. So the next, we'll take a couple of more questions. So the first question is obviously going to be, since you mentioned, the sub value chain moving to India from China or other places. Quick take on specialty chemicals, which is one of the most speculated industry to gain significant advantage out of this move. And so we'll take this question first. And also to this, can you give us examples of what you called emerging brands, what you called matured brands we would know, and what you called turnaround brands with real company examples? I think, yes.
So I'll take the second question first, which is, sure. We gave an example of V-Guard as an emerging brand. And I will explain the concept of emerging brand, established brand, and turnaround brand in that context. So V-Guard is a company from down south of India in switches, cables, electricals, for very profitable and good high on corporate governance. expanding on categories and looking to go national. So that's the emerging brand. Mid cap or small cap in the traditional language forms about 40% of the portfolio. An established brand is a national brand, which is already present in all parts of it. So, if you talk about V-Guard in Delhi, very few people may be aware of it, but people would know V-Guard in South, loud and clear, because they have been dealing with that company for the last 30 years, which is at least the least vintage that it takes to create a brand. On the established brand side, we are talking about national brands. Whichever part of the country you go to, people would know Havels. So Havels is an example of established brands. And by and large, there they can do more category expansion, but by and large, they will be more steady growers than that of V-Guard, where the growth potential could be higher. So that's an example of established brands. They are about 45% of the portfolio. Turnaround brands are brands which have had a strong past. So let's take ICICI Bank, for instance. If you still go to the hinterland, they have a strong brand recall. They have a strong deposit franchise. But over the last 4 or 5 years, they have fallen by the wayside because of their mistakes in the corporate lending book and stuff like that. So these are the examples where they have fallen by the wayside and are looking to make a comeback. So these are turnaround brands which we are looking to capture in the case of our portfolio. So emerging brand, V-Guard, established brand, Havels or Asian Paints or HDFC Bank, turnaround brands, Axis Bank, ICICI Bank. Now, what was the first part of the question again?
Specialty chemicals
Specialty
and
chemicals.
probable gains.
Yeah. So specialty chemicals clearly are a beneficiary in the context of China because China is vacating that space. But slightly higher end is APIs, which is where brand formation is important. And I would highlight one of our holdings, which is Divi's in there, where, overall, given that now the supply from China is limited, Divi's has benefited significantly from this and will continue to do so over the next 3 years from this particular segment. So I see that as a high growth segment, and I see Divi's as part of our portfolio as a way to play this. And we would be positive in this segment as well, along with specialty chemicals.
Sure. Thank you. So now the last question, and we will leave things incomplete if we don't take stock specific questions. So I'll ask pertaining to Bajaj Finance as to the credit risk now seems heightened. The moratorium and with everything going on, the economy doing what it is, people losing jobs. What do you think is the credit risk at Bajaj Finance, A? And B, one of the largest brands in the country, ITC, is not in your portfolio, or if there is, it is not in a big way. So your responses to that, please.
Yeah. So as I highlighted, I will take the second question first, the ITC one. Two of the filters that are important for us, one is growth, the other is return ratio, and third is the company's ability or the company's investment in creating a brand. So ITC clearly qualifies in the fact that they have made sufficient investments in creating a brand. They have been a brand creator and one of the strongest brands in the context of India. Second, their return ratios are also particularly great, and they have done quite well from that perspective, and they do meet the criteria from that side as well. But the third part, which is the growth part, is where it gets stuck. The growth has not been particularly impressive. And by and large, and hence ultimately we are looking at wealth creators which can grow, because growth is an important part for wealth creation for investors over time. So that's one of the reasons why ITC, despite being cheaper on valuations and also having met the two of the three important criteria, doesn't make the final cut. I would not get stock specific with regards to Bajaj Finance, but I would say that more generally, there is credit risk all around. It's a question of where the franchise is strong enough to withstand the risk, and do they have enough on the backstop or the balance sheet to sort of take them through this crisis. I think if you look at one of the stronger brands within consumer lending, if I were to find out today in the marketplace, they would be one of them. And I think stronger brands will obviously weaken in the short term in the absence of demand, but for sure will emerge on the other side. Whereas a lot of their competitors will actually go bankrupt. And as they go bankrupt, they vacate the space. The companies like the ones that you mentioned would actually kind of stand to gain market share, even though the overall growth may not look astonishingly high. But on the other side, when they come back, you have lesser competitors, a consolidated market, and their cemented position. So I am looking at it from a longer term, 3 to 5 year perspective, where companies like the ones that you mentioned, like HDFC Bank, Asian Paints, etc., will emerge as a strong winners, strong market share gainers. That's what I'm focused on. I'm not focused on the short term. I can't get the earnings estimate, or nobody can get the earnings estimate in the short term right. The time, as I said, is to focus on bottom-up strategies where you are investing in a brand, you carefully select it in such a way that they emerge as winners on the other side. And as long as you do so, as investor, you would be broadly fine.
Thank you. Thank you so much, Srideep and Manish.
Thank
Audience,
you.
thank you so much for attending today's webinar. To know more about the Axis Brand Equity Portfolio, you can visit our website www.pmsaifworld.com. And we look to see you on other webinars too. Thank you, Team Axis.
Thank you. Thank you so much. Stay safe.